Now let's have a look at our two types of investing accounts. We have taxable investing accounts and tax deferred investing accounts. Remember that the tax deferred accounts are our IRAs and 401ks, and this is all in Chapter 14. And this table highlights for us in red things that are bad for us in terms of taxes in a taxable account and things that are good for us in terms of taxes in a taxable account, and likewise green and red for the tax deferred accounts. Note that in our taxable accounts, the money that's going into that taxable account has probably already been taxed. For example, it's coming out of your income. Whereas the gains and dividends within that taxable account are also being taxed. But the good thing is when you withdraw money out of it, the monies are not taxed. In contrast, the money going into your IRAs and 401ks has not been taxed, and the gains and dividends inside of those tax deferred accounts are also not taxed. So that's really great. But when the monies come out and you need them in retirement, then they're taxed at the income rate. Now, what we need to understand is how do these investments grow during our investing lives, say from age 30 to age 65, and then see how do these investments change during the withdrawal times during our retirement. In other words, which one is better for us? So let's have a look at the spreadsheet. So here is the spreadsheet, taxable or tax deferred. Let's set up the defaults for this for our first assessment and just hover your pointer under the red triangle. And we see we need to change this value to 50,000 and change, I believe, this value also to 50,000. And then have a look at these others through here, and they all are set up correctly. Over here, what we're going to see is our taxable account growing at 10.5% a year starting at age 30. And over here, our tax deferred account also starting at 50,000 at age 30. Now, the reason why the taxable account grows to a smaller value is because there are dividends that are coming out of this taxable account. Dividends and interest, so interest on the bonds and dividends from dividend paying companies. Well, those dividends are issued probably quarterly, something like that, and you're going to have to pay taxes on those. And so here I've estimated dividends at about and interest at about 2% of the overall portfolio value per year, and you're going to pay some taxes on that 2% that's being pulled out of the funds. And so that I'm going to estimate those taxes at 10%. And you can get into the taxable spreadsheets, these spreadsheets down here, and figure out what the tax rates would be. But it works out to roughly 10%, which is kind of close enough for making this comparison. So these values in through here are being subtracted from the taxable account, but because this person is having to pay these taxes out of pocket, well, this person over here with their tax deferred account, they're not taxed on these dividends because it's in an IRA or 401k. But because this person over here with their taxable account is paying for it, this person over here has the money too. They could invest this money into their account. So this person's getting it subtracted, and this person over here with their tax deferred accounts is getting it added. So they're really growing. And what we see then at age 65, we just scroll down here, we see the growth. And of course, this is a model-based growth at 10.5% for both of these. And that's the growth of the S&P 500 over decades and decades. So we scroll down here, and at age 65, we see that the taxable account grows to 1.54 million, and the tax deferred account grows to 1.75 million. The spreadsheet automatically copies those two numbers over to these two positions because we started at age 65. Now, in our retirement, we're probably going to be a little conservative with these investments. We're probably going to shift more to maybe a 50-50 portfolio of bonds and equities. And therefore, the growth may be actually quite slow compared to the 10.5%. Maybe the growth is only 5%. And again, you can change these numbers to what you think is more correct for you. But the thing we want to do is have both people living on the same after-tax money. So these two columns here, H and J, are the after-tax money. Remember, these people are going to pay long-term capital gains rates here with the taxable account. So if we enter 109,000 there, the spreadsheet down here will automatically calculate the tax rate for you. And see, it's not even 11%. Over here, you have to enter in a greater withdrawal because these people here with their tax deferred accounts, they are taxed at a higher rate than the taxable account. They're taxed at nearly 20%. because they hadn't been taxed at all before. You always got to pay the tax man, so to speak. So the tax deferred accounts are taxed at a higher rate during withdrawal, during retirement, than the taxable accounts. And the natural question is, which one of these comes out ahead? Well, we see that in the case of the taxable account, it's starting at a lower value than the tax deferred account because of this subtraction of these dividends. And then, of course, and the tax, I should say, not the dividends, the taxes on the dividends. And that's actually over 30 years, is a pretty substantial difference there of about $200,000. So now let's look at the plot. We're going to just scroll over here to the plot. We see your age across the bottom, and from age 30 to age 65, there's the growth in the tax deferred account in blue, and over here's the growth in the taxable account in green, and now we're going to withdraw monies from there. We're going to withdraw but different amounts. We're withdrawing different amounts. This 109,000 and 121,000 are going to get withdrawn from these two accounts as noted here, but they are going to have the same after-tax living money. You want to live the same. And so after-tax money is this line right in through there. So what happens then is we're withdrawing less from the green line, more from the blue line. The blue line starts at a larger number. The green line starts at a smaller number, withdrawing less, and they both end up at the same 0 point at about age 84. So in other words, neither one of these accounts was better than the other in terms of when we run out of money. You want your money. We want this running out of money point A. We don't want it to happen. We really want these lines to be over here. And if they do run out of money, we want them running out of money much, much later in life to after we're dead. We don't want to run out of monies while we're still alive. And I think many, many people can expect to live into at least their mid 80s. So this is cutting it pretty short here. As with all the spreadsheets, let's just make one change at a time to see the impact of that one change. And maybe you've heard that people are being encouraged not to retire at age 65, but to say retire a little later in life. Let's just add 3 years. And of course, 3 years when the investments have really grown, just a small percentage of growth here can really amount to a lot of money. So let's see what age 68 does to change these overall numbers. And remember, we're at about it looks like 1.5 million and 1.7 million. And let's see how big these get. Well, now they're both greater than $2 million when we change to a retirement at age 68. And we see that now both of these lines are going to zero out in our late 90s. This is a far more understandable position. It's a far better position to be in terms of retirement. So somebody like this might be encouraged to retire a little bit later than age 65. Let's make another assessment, change this back to age 65, but we're going to have this tax deferred account actually start at 60,000. The idea being from the age of when you graduate from college around age 23 or so to age 30 is when you're trying to grow this nest egg of 50,000 and 60,000. Because this person over here was investing in their taxable account, they were paying taxes as those investments went into to accumulate to 50,000 at age 30. This person over here with their tax deferred account was not paying taxes, and we've already learned that in the tax conversation in chapter 4 as well as the budgeting chapters. They might be able to have more money invested. And let's just say they have about $10,000 more invested. It's a very reasonable scenario for comparison. Well, now we see that yes, the taxable account is still at 1.5 million, but look, the tax deferred account grew to this $2 million number that is far more helpful for us. And then when we scroll over, we see, okay, the tax deferred accounts, the IRAs and 401ks, both people are living on the same amount of money, after tax money, but even though the IRAs and 401ks are being taxed heavier at withdrawal, they still last longer because they start at $500,000 or so higher. Again, this is a much better position to be in here with our IRAs and 401ks than over here with the taxable account. And that's because there was a real advantage to growing that initial amount at age 30 because this was a tax deferred account. And now one more assessment. If both of these accounts have the same money in them at retirement, let's see which one is better. So what we're going to do is set this up so that both accounts have the same amount of money, same $2 million amount of money in them at retirement. We're not going to, over here is a little bit of, really this kind of investing scenario may not actually happen, but nevertheless, let's say they both have $2 million in them at retirement, and both people are trying to live on the same amount of money after their taxes have been applied. And here we see, yeah, now if you start at the same amount of money, the tax deferred account is not as good as the taxable account, and that's because the taxable account has a much lower tax rate to it compared to the tax deferred account. The tax deferred account has to withdraw more money in order to live on the same amount as the taxable person. Well, I hope this is helpful for you. There's a lot of tax babble right there, and it can get a little distracting, but I hope this spreadsheet helps you to understand why these tax deferred accounts are highly advantageous to you, unless, of course, you start with the same amount of monies at retirement. And this is kind of an unlikely scenario, but nevertheless, it's helpful for completeness in this discussion with you.